All right, I want to welcome everybody. A little bit harried. I'm having some technical difficulty with my computers, but I think I have it all resolved. Let's see. I wanted to start tonight really by just a recap of a couple of things that we discussed last week and up to this point, really relative to some of the issues about scan, watch, and play using tools that help you become a better trader, investor. And so what I wanted to do tonight really was kind of start with the desktop. So at the bottom here, I created an example of a desktop that allows us to hopefully look at what goes into putting it together. I had to build at least the remnants of it so that I could not have to go through the nuts and bolts of it. But for me, what is important is I try to set up a desktop just like I trade, which is on the left side is scanning and research. So this is all the research components of the what we will do on a day-to-day basis really exist over here, in that I can run scans, I can write my notes, and then there's more scans at the bottom that we can look at. And I'm going to come back and we'll talk a little bit about how to build those views. But then on the right side this is the watch list. In other words, this is what we would actually be watching relative to the results of the scan. So you scan the market to start with, then you develop what is a watch component for the market, and then the last piece of this is the actual trades themselves and a tracking mechanism for those, which is another watch list. So you build the platform that I look at is through a scan, watch, and play. So everything flows through the desktop so that I can see exactly what's going on relative to the market at any given point, and it allows me throughout the actual trading day to see things I want to see, and we'll talk about how we do that, and then how to manage things throughout the day, which is the ultimate thing we're going to speak about tonight, which is managing those in-betweens, managing the positions, and to prevent ourselves from giving up what I think are good positions just because of certain events that are taking place in the marketplace on a day-to-day basis. So what we look at each day is the scan. So looking for the opportunities, which is what we covered a couple weeks ago, was how to run some of these scans, which you can see up here is just a basic ETF scan. And all it's looking for is leadership on any given day. And the scan will so it runs for what's happening through today or through whenever the moment the scan is run, and then we build filters along the way, which we discussed in the other webinars, and on how you can use these tools to sort, filter, and find quality investments or opportunities. As you go through the scans, they're going to get filtered down to a watch list, which is what I have over here on the right. And this is one that I just put together today, which is essentially a watch list of 24 things that came out of scans, whether they're ETFs or scans of ETFs for individual stocks, or for things that may be setting up in a pattern format or different events. And if we open them, you can see IGT, which is International Gaming Technology. This is just a pattern play that when in doing the scans, you can see you got a pennant and then you got another pennant, so you got two pennants, and you're looking for a continuation to the upside, which is essentially what you got today. All right, let's try this again. So when you set these up, essentially all you're looking for is a way to track different pieces. In tan, we were looking for a continuation breakout. Here you broke the downtrend, you tested it, you broke higher. Tan is actually the egg that we took on Monday, and we still hold that today. but I'm still looking for this as a continuation above the 44.40 level, which would take it back up to 46.30. So it does two things. It allows me to add to my position within TAN, and it also allows me to manage the position that I have currently within TAN. So TAN would show up in both lists. It'll show up here and it'll show up down here. And I can manage it relative to the perspective of what I'm looking for. I can write notes to it. I can do so. In other words, I'm managing each part of this as I go along. And to me, what's important about trading / investing is that you manage your thought process throughout the day. And this gets into more of the psychology of trading than the actual nuts and bolts of trading. But the psychology of trading, to me, is about 85% of what you do every day is dealing with the 4 inches between your ears to keep you from blowing yourself up and understanding exactly what the process is coming into the trading day. So if you're trading throughout the day, it's very different than if you only trade mutual funds or you're looking longer term, so your trade events are less frequent. It's a different psychology on both sides of those, and both of them actually ultimately work together. And we'll look at examples of that before we're done tonight, of exactly how the two meld together. But the important part for me is being able to manage the flow. In other words, I want to be able to manage the scans to the research to the trade, and then I want to be able to manage the trade. So to me, it's a flow process that keeps me in tune with what's going on with the market. Last week we talked about understanding the market's personality and what it's doing right now. And let's deal with that, since we're on this, as a recap by using what's actually going on in the markets currently. And if you read the notes on a daily basis, then you would know some of where I'm going with this is that the last 6 to 7 trading days, what we've seen in the market is, I can't really say it's a lack of leadership, because we still have leadership, but we're seeing is that the leaders are getting broad. In other words, they're moving broader, and so the breadth of the market is widening out, and you're picking up things that have lagged, which is how a uptrend should work, is that it should start with specific leadership, and then it should broaden. The broader it gets, the better the trend will be over the longer term. So breadth of a market move, to me, is very important. So I think what you're seeing right now is, by the broadening of this leadership in the market over the last 7 to 10 days, is a positive sign for the current bounce that we experienced off of the May 15th latest low. So where we're heading now is really, no one knows. I mean, I'm getting emails from people, I get questions from people about the fact that the market is extended. Extended according to what is really my question. You know, I don't really like buzz phrases that people throw out. The market's overbought. Well, what does that mean? You know, the market's oversold. What does that mean? You know, if the market is oversold and it's still going lower, then it really isn't oversold, because people are still selling. If the market's overbought but it's continuing to move higher, then it's not really overbought until it actually moves lower. So to me, we almost try to prognosticate, if we look at this chart of TAN here, when it starts to roll over right here, this is where everybody decided that TAN, which is the solar ETF, was overbought, because then they started selling it. And down in here, as it started to rotate back up, it made an attempt to bounce off of an oversold situation, but it really wasn't done until it created a higher low and broke from that here, which it did last week. So to say it's oversold or overbought really doesn't mean anything to me. To say the market's overextended is a phrase that doesn't really mean anything to me either. What I look at is that the market, can it justify its fundamentals? In other words, can we justify price to earnings? And if we cannot, then we're overpriced, and we have to actually make adjustments at some point. But until that adjustment, like here, is made, it doesn't matter what I think. You have to wait for the adjustment. You have to wait for the enactment, and that's where swing trading has come into play a lot for a lot of people. But you're looking for that movement that will define the personality of the market. The market is in a very well-defined uptrend, long-term, intermediate term, and short-term. Where it's not clear for some people right now is in what I call the micro term, and this is a micro trend right here because it's only about 3 or 4 or 5 weeks long, so it's a micro trend. You don't really get to a short-term trend until you're 90 days out, and so that trend would have to continue for another 6 to 7 weeks in order to establish itself as the short-term trend for TAN. And currently, if we scroll this back, we would see that that's your picture for what TAN is relative to right now. It's a big mess. It had a big head and shoulders that failed at the neckline and actually reversed. Now, that could come back to haunt solar, and we actually do go to the downside, but you can see how well it's held the 200-day moving average, but it's worth a trade right now because it's in a micro trend. When it becomes a longer cycle, then it becomes an investment to me. Anything past 90 days becomes an investment, and I'm looking or prognosticating with a lot different picture than I am from a micro trend within the market. So hopefully that makes sense relative to understanding. Don't let trend buzzwords trip you up on what the market is doing. You know, if you're a short-term trader, then you are worried about the microcosms of the market. And right now, here's the May 15th low. We're working off of that low on a micro trend that's on the upside. We talked about last Thursday night, as a matter of fact, we talked about the fact that the market had come back to support at 1925. It was going to do one of two things. It would either bounce off of that support, which it did, or it would break that support and test down to around the 1880, maybe 1900 to 1883-ish level of support. It didn't do that. It bounced. So the minute it bounced and solidified that bounce, there was another trading opportunity, and that's actually played out very nicely over the last 4 or 5 days. So you got, when you look at those type of events, take advantage of them. Take advantage of what comes off of that and find it by knowing what's on your desktop. In other words, when I go over here and I scan my list and I see what's filtering to the top, then I can play off of that very well. Now, because I was doing the updates before I frantically realized that I couldn't log in tonight, I'm going to use kind of what you can see behind how we actually populate the site. But I want to use it because I need the text out of here, because this is the egg scan that was posted tonight for tomorrow. And the reason I'm bringing it up is I want you to see that we're getting a broader market move. And I think what I try to do is help people understand why, to some degree, the market's doing what it's doing in hindsight, and then how do you use that hindsight to look forward relative to what you want to be traded and or invested into. And what you can see here is that going back to last week, you can see Russia, and you had semiconductors and palladium and natural gas stocks moving, and then oil. But notice that the gold miners started showing up last Thursday on this scan, and they didn't really ever go away. As a matter of fact, they came back in full bloom today because the gold miners were up. GDX was up 4%. GDXJ, which is the junior miners, was up 5%, and the silver miners, SIL, was up over 6.5% on the day. Gold was up 3%. Silver was up 4.5%. So you had precious metals, which started setting up last Thursday to move, really came to fruition really yesterday. They showed up. You could see Nugget, which is the gold miners, and some of these things showed up yesterday, giving breakouts that were confirmed today. So you had opportunities to see the evolution of that if you're watching what the leadership of the market is. And that's how we get to the egg on a regular basis, is looking at where's the driving momentum relative to the last 5 to 10 trading days. What do we see? And how does that reflect the personality of the market going forward? And then we attach indicators to it, looking for what will evolve as what we, because it's not just about who's going to give me the greatest return. It's about what will give me the greatest return with the least amount of risk relative to today's market. And so it's a risk-reward relationship, and not just who's going to give me the biggest bang for the buck, because I can lose a lot of money doing that. And we've run the models many times over the last 32 years, and we validated that you can lose a lot of money by not managing risk, which is where I'm going with tonight's notes, is that you have to understand the risk of what you're playing and validate it before you put it into play, because all of those things are very important from my perspective as to how you get to where you want to be. So scan, watch, and play. Set your desktop up and use the tools that you have. And if you're a Telechart user, you know that you can build easy scans up here. You can see the scans that we have built that we run. They're very easy to use, and they're very applicable to a lot of things that people do on a day-to-day basis. So once you build them, all you have to do is plug them into the list that you want it to scan through or filter through. You can build columns, which we talked about. This is a recap of some of the things we've already done a couple weeks ago, but I'm looking at, how do I filter and find? Once I find what I want to watch, now I want to watch it and put it into play. And so what I wanted to spend the time on tonight was actually putting trades on and then managing the trades themselves. So I want to go to TAN, because that was the egg trade that we actually posted on Friday or over the weekend. And then we got the follow-through for that coming into today. So I'm going to pull up the website for a second here. And let's go over to the egg model. All right. And the reason I want to pull this up is I want to use the exact numbers. And you can see we posted it on 6/15. TAN is Guggenheim Solar ETF. There's no leverage used on the ETF, so this is just a straightforward ETF. And then what we're looking for is, when you look at where this is going, is how did we get to the egg? And, there's so much that goes into this. It's very hard to, in a quick webinar, to just kind of give you a Reader's Digest version, but here it is in as succinct of a manner as I can do. Is because the egg is a short-term trade, you're looking for momentum. There's no magic to that. You're going to look for momentum. Secondly, is you're looking for evolution of momentum within an asset class. And so within the asset class, there are only 7. So, there's no real magic to that, in that there are 7 asset classes. If you have the desktop, if you have subscribed to the desktop, then you know that if we go, let's just go over to that, you can see here's the 7 asset classes right here, and that you've got the EFI, which is global stocks, you got emerging markets, you've got treasuries, emerging market bonds, the dollar, commodities, and real estate. That's all there are. If you took all 7 asset classes and rolled them out, you would encompass every investable market asset there is. And then there are other, things like collectibles that you can't invest in other than collecting them. But the fact that these incorporate everything, we use the U.S. stock market as the benchmark because that's where we live. So we use VTI, which is the total market ETF, and we benchmark against it. And then we look for pivot points. And every pivot point off of the previous day in a contradictory direction is what we're looking for. An example would be that's a potential pivot point. This is a potential pivot point because it went down. This potential pivot point, it went up. it takes them sequential days before they validate whether or not they're, in other words, all we're looking for is in the pivot points is a trend change. Is a trend going to change from the current trend that we're in relative to the U.S. markets? And you can see that each of these that I've laid out of different pivot points have not validated. In other words, if this was a pivot point potential on a reversal, it didn't validate because we never established a lower low, which would break the trend line that we're in. That's really the magic of it. There isn't any. And so what we do then is compare the asset classes to one another off of the U.S. equity markets. You could do it off of the EFI. It doesn't matter. There's no magic. You can type right in here and say, I want to compare these to EFA. It changes the chart. If I want to compare them to DBC, which is the commodities, it changes the chart. But I use U.S. equities because that's what I'm the most involved in, and I want to look at other asset classes relative to that. Are they outperforming or underperforming? Do I want to be overweight or underweight to U.S. equities? That's all it comes down to on a simplistic view. And then I'm looking for things that move against the U.S. market. And you can see right here on this dark blue line at the bottom, which is commodities. Commodities gave you a potential pivot point that actually confirmed right here. In other words, it started to break above this previous high, so you got a reversal, and now you're moving higher the last 4 days, which confirms that commodities are breaking out. So you're looking for trend momentum, and then you're going to dig into commodities, find out what's moving, and then you set up your potential trades from there. And then we parameter them by risk. How much risk do I have investing in commodities versus solar? How did we get to solar is one of the biggest questions that you'll probably want to ask. And how we got to solar is really quite simple. We got to solar from the standpoint that energy is moving. And if energy is moving, something is driving it. So let's go back to a daily chart here. And let's put up XLE. In other words, so we break out of energy back here on the 15th of May, which was a low. We break out of this consolidation, continuation of the previous uptrend. We break out energy's driving. What's driving energy? The most logical thing that was driving energy is oil prices. Oil prices go higher. Profits to energy companies go higher. They can drill for more, which would expand exploration and production companies and blah, blah, blah. So what you get is you get this evolution or domino effect of things that are moving. So the simpler you can make this is why I always go back to keep it simple. The simpler you can make this, the easier it is to track it. Energy's moving. How do you know that? You can see the trend lines are moving. Energy's breaking higher. What's breaking it higher? Well, we can dig in and we can look at. Oil's moving higher. Are the conglomerates moving higher? In other words, when you start to get a break higher, then Chevron should be leading. If oil is an instigator, and ExxonMobil and ConocoPhillips, I mean, we should know what's leading it. And if those big conglomerates are leading, it's oil prices that are driving it. If it's not oil prices, what is it? Well, it could be natural gas, and if natural gas is leading, then the natural gas stocks should be going with them, which they were. So you had a two-pronged approach in this. You had oil and natural gas. Natural gas is an alternative energy to crude, which is why you're going to see natural gas drive. But a second alternative to natural gas is solar, and solar started to move the same way. And since we have an ETF for that, we can track solar through TAN. You got a bottoming, you get a breakout, and that's all there was to factoring it in. How much risk did we have? We thought we had minimal risk because look at the correction that you had within TAN. You went from 51 to 37. You had a $14 pullback on a $51 share. You already had eroded 25 to 30% of the value out of these solar stocks, some of them more. So if people are saying oil's going to 110, 120, $200 a barrel, then alternative energy would come back into favor as that gets validated, and that's essentially where it goes. So a lot of our research into the egg goes beyond the technicals. It goes out into the fundamentals, and it goes out into the market personality right now to drive that home. but that's all done through the scans. It's done through building a watch list and understanding all the pieces that go around it on a day-to-day basis. I mean, you have to kind of tune in to what's transpiring. If we were not already invested in TAN yesterday, then GLD would have become the egg yesterday, because we've got a perfect micro cup and handle development here. But the last 4 or 5 trading days, if you go back and look at gold mining stocks, not the metal, but the mining stocks don't look the same on the chart as gold does. If you look at the mining stocks, they were breaking higher before gold. So the miners were leading gold prices in anticipation that there was a belief that gold prices would go higher. And so you had a leading indicator on gold that gave you really a lower risk probability trade taking GLD. Now, would you have made as much money as you would have made in GDX? Absolutely not. But I felt the risk of the extension in the miners is much higher than it is in GLD when you're not extended. You're still got a downtrend you're dealing with. Regression went perpendicular. Look at the regression line going perpendicular on today's move. You had a lot of indicators that were rolling into there that gave you some interesting components there that is very important to me. So if you, if you look at all of these things, you can plug this in to just about anything that you do. You can look at things from a standpoint of what is developing on the horizon. And it can be a short-term development. It can be a long-term development. Natural gas to me is a long-term horizon development. Solar is a long-term development that has been banged around. Cloud computing is a long-term development. I mean, these are, they're not just trend-changing events. They are really creating new markets. And as they get created, they create greater and greater opportunities from my perspective. And so those are things you want to take note of and dig into. Internet stocks are not, a lot of people said they were dead. They're coming back. You have to kind of take into account what each of the components of the markets do and let the story or the themes of the market unfold for you. And that does take time. It does take energy. It takes effort to do that. But for me, it's been very rewarding as a trader to see ideas unfold and to see how they get to become profitable investments as we go along. And I think agriculture is another one that we can't ignore. We're going to have to feed the world. The global population continues to grow. Water is another theme that we stay on constantly, in that we don't have enough water. We're going to have to find ways to do that better. Other ways that you can track some of these things is clean energy, which is PBW, which is a portfolio that PowerShares puts out. And the reason that I look for these is that I'm looking for that ETF, but I'm also looking at what's driving it. Here you can see REE, which is rare elements. This is an industrial. This is because steel is moving. Finally, we've got steel moving again. This is another theme that's out there in the base metals component. If you look at DBB, you're starting to get some consolidation, and you may see some breakouts into the base metals coming along. SLX has started to move up, which is the steel stocks. You have a lot of, opportunities, but the rare elements, these are things that really go into steel manufacturing. You can see the consolidation breakout there. And how we got to some of this is you can see steel well within this consolidation, and eventually, will steel break out? I can't really say yes or no, but I do track it and we do look at it. But I do know that within steel is AKS, and I do know that I own AKS, and I own it off of this breakout. You can see the reverse head and shoulder pattern right there, broke above the regression line. That's been a great trade right now. It's down a couple points on the day. But, I'm not saying this is a long-term buy. I'm just saying it's an opportunity. The opportunities are created by things that are out there relative to how you track all of these things. And we start it every day, really not every day, every night by doing the egg scans, which I did tonight. and we can see really what we're looking at relative to the markets themselves and what's leading, what's lagging, what's moving, what's not moving, and eventually they will filter and they create some theme out there that's going to relate back to them that gives me the opportunity. Now, all of that said, let's go back to what we were trying to look at with this desktop example that we started with tonight, now that I've gotten off track onto the egg. But if we look at this from a research standpoint, we're going to go back to how we got into the trade. And let's look at TAN, which is where we started. And let's go see if I can find the web page again. And what we're looking for is an entry at 42.30 on TAN. Now, I'm going to do this. I took this off the chart just so you could see. All we're going to do is we're going to put 42.30 right there as the entry. You can see it's on the entry of the break above here. We want to clear it a little bit, confirm it. We want to see volume, all of those things that go into the trade entry. But we want to buy TAN at 42.30. Now, I'm going to use two lines here. One is at 42.10 roughly. And I'm going to take this line, and I'm going to come in. All you do is right-click on the line, and I'm going to click Set Alert. And I can set an alert for TAN going through 42.10. Why do I want it before I get to 42.30? If I haven't entered my trade yet, then I want to go to where I can enter my trade and buy TAN at 42.30 by simply putting in a buy-stop order at 42.30. And so I'm going to put the trade in, and I can write the description in here is, TAN approaching entry. So when the alert goes off, it's going to come up with this description, and it's going to say TAN is at 42.10, and it will see, approaching entry. And so you can set the alerts off the trend lines. And then I can set a second alert by just right-clicking on it. On the second trend line, I'm going to put in here confirm trade. So in other words, if I have a buy-stop order in, I want to confirm that the trade went off at 42.30 and that I own it, because now I've got to deal with it and I have to manage it. So I own it. I'm in it, and that's simply how it's done. I mean, there's no magic to placing the orders. If you have Warden now has a trading company called TradeFire that you can trade right off of the charts, which is another plus that you can use within this. But if I want to trade off the chart, then I'm going to bring this to 42.30 on the trend line, and I can come in and put in my stop order. It's a buy order, and buy TAN is good for the day, and I want this to be at 42.30. And so there it sits, and if it hits it, the trade gets executed. I tell it, I want to buy, in this case, we bought 4,000 shares, and so we own 4,000 shares at 42.30. So we set the trade, the desktop up so that we can get into the trade, and now we can go through managing the trade just as equally. And I'm going to do this with trend lines first, is I'm going to go down to where our stop is. And the stop would have been a reversal, and the initial stop was a reversal that took out right in here, this level, which is 41.40-ish. So if we got a reversal off of that, we would take it out, and we would exit the trade. And then as soon as we get confirmation the first day that it goes up, I'm going to raise my stop the very first day to the close of the bar right there. So that's when we bought it, which was on 6/16, because it extended itself and it actually closed on the end of the day at 42.76. I raised my stop to 41.62, which is the bottom of that bar. So if it reverses and goes back below it, it negates the entry, but it also just cut 20-some cents, almost 25 cents, off of my potential loss, which is managing the risk. Now, each day that it ratchets up, I'm going to move my stop up with it, And I think our stop right now is at 42.30 or 43.30, which, by the way, is this volume at price, because you see how big the green part of that bar is versus the red part. There's a lot of buyers who bought in at that level, whether they bought in over here, wherever they bought it. There's a lot of buyers at that level, and I want to be out if we go back below that. And you can see today we didn't violate that stop. We closed at 44.10, and then tomorrow we'll come into the trading day with our stop probably around 43.55-ish on the day, maybe 43.70, which is the top end of this volume bar, which was, I mean, right now 43.70 is where I'd like to be out of the trade if we reverse off of this. But my point in that is, because this is a trade, this is not an investment. In other words, I'm looking for every egg. Here's the plan of the egg. Since this is an egg trade, and we'll go back and look at other trades as well. But for every trade that I take in the egg, I have to define how much money do I want to make. I want to make 1% on that trade. Net to me, 1%. And you say, well, why would you bother for 1%? Because we average 52 trades a year. If all of them are profitable, we make 52%. If only half of them are profitable, we make 26% on those, assuming we didn't lose a lot of money on the egg that made money versus those that lost money. If you look at tan, this trade right now is actually up over 4%. So we've made 4% on the trade. That 4%, which is 3% above the objective, will offset the losses on the bad eggs. So the rotten eggs we get to offset with the excessive gains on the good eggs. And that's really how the whole strategy is developed relative to return, is 1% manage 52 trades, 26 that net 1% and 26 that net 0% loss. And I know I'm going to lose money, but I'm offsetting the losses by the excessive gains against the 1%, which is why we're very aggressive to manage the 4% gain, because we know we're going to need it down the road to offset the rotten eggs. And that really is the strategy. You have to have a strategy designed to anything you do in order to commit to the process and the discipline that it goes with. So that's getting into the trade as far as the egg is concerned, and that's how we manage the stops of the egg. Now, what about trades that aren't an egg trade, that may be a pattern trade, an S&P 500 trade, or any number of other trades that we would like to own? Well, let's go over to XOP, just because this was a pattern trade that we took. And let me pull this back so I can get the date off of here. On 6/9. Oh, sorry for moving that so much. And if we go back, here is 6/9. So as you can see, obviously we use a lot of technical entry points just because we find them to be very beneficial. What you had was kind of a very shallow V bottom move here, which you can see it's a very symmetrical move off of XOP, which is the energy sector. Energy, as we've talked about, was in favor. So anytime we get this type of a pattern consolidation move, I could buy it on the continuation of the uptrend. Here we did not, just because we had issues surrounding whether oil prices were going up. A lot of things were going on in the market there. So we decided to take it off of this breakout, which is 6/9. Right there is the move. Now, not to bore you, but to make you understand simple, is I'm going to give you, if you're not great at setting stops and you're not good at managing positions, then I'm going to give you some simple tools to use. And if in pattern trading, It's always the height of the pattern creates the target. And so here's the bar. So there becomes the target for the trade. In other words, the height of the pattern, this is a shallow V bottom, the height of the pattern creates the target. So we take a horizontal line, or a vertical line, we pop it and we drag it up to here, we create the target, and there visually now is the target, and I can actually type in here, target. And there it sits. And then down here, I can type entry, and the entry price for this was $78.40, so I just type it into the entry line, and now I have entry $78.40, target $83.20, and what's the next thing I want to know is where do I get out? And I'm going to set my stop on this particular pattern trade by a violation of the trade, which for me was right in, I got these on Snap, but right in this area around 75.92 or 76. I'm willing to risk 4 to 5% on the trade if the breakout validates itself, and then we ratchet the stop as quickly as possible into a reasonable format. So we give it room initially to move, to test and then run, but if it tests and breaks, then we want out of the trade. But it ran because these were pattern trade setups, so you have to use all the technical rules. You get into the trade, and then now I have my stop set on the trade right here. Now, that's about as simple as I can make it, is that visually it's there. So now I'm managing my positions, and I'm going through my charts as I go through my position charts on the day before the market opens, before it doesn't open, and I click on XOP. That's already on the chart. I already know where I bought it. I know where my stop is. I know what my target is, and I know what I should do on any given trading day, how I want to manage the position. And if we take this and move it forward, so we get the breakout, we get a little bit of a test back to the trend line on the break, it follows through again, and we're in the trade. Now we get this follow through. We could raise the stop up to here on that follow through, but we probably aren't going to do that. We're going to wait for this bar, and then we're going to bring our stop up to the bottom of the previous bar. So we're going to let it have that much room, which essentially is getting us very close to break even on the trade. We're out of the money on the trade of about $1 on $78, which is, a couple of percent, but we cut our losses by 2/3 off of that bar. And now what you end up doing is you go to the next bar and you see what happens on the next day. It closes higher. We're going to take our stop to break even. And you can see what's happening is you're just managing the trade one bar at a time. And then we're going to take our stop up to the bar here, and we're going to just come through all the way through to where now our stop is going to be right here. So we're at why? We're approaching the target 83.20, 81.15. We're still out $1.60 off of the high. We lock in 81.15 off of 78.40. We're just managing the profit. We're managing the trade. This is a trade. We're not managing a longer-term asset. We're just looking at how do we ratchet this up so the event that the market reverses or that XOP reverses, we're taken out of the trade. That's how you want to manage the trade. But it's done off the desktop. We are managing all of the risk relative to each component that we see. And so we scan the market. If you go through all the headache of scanning the market, building a watch list, doing all of this, and then entering the trade, but you don't manage the trade logically, you manage the trade emotionally, you're going to kill yourself every time. A lot of people manage off of these red bars. I manage off the green bars. The red bars will take care of themselves. If my stop is in the position it should be in, the red bars will take care of themselves. The down days take care of themselves. It's the green bars that I want to manage. It's the profit of the position. And I'm always managing the potential loss because my stop is there. I want to know how to manage the profit. Managing profit, believe it or not, is harder than managing losses. People they are quick to take profit. And you've always heard the analogy, cut your losses and let your profits run. What we tend to do is cut our profits and let our losses run because we hate to take a loss. So if it's always on paper, it's not really a loss because there's a chance it'll come back. But psychologically, we're blowing ourselves up. The bigger the losses you take, the more brain damage you create. And the more brain damage you create, the harder it is to jump the next hurdle. Each loss creates a scar. And those scars build over time to the point that it makes it very difficult to be a consistent trader because we're scarred by the fact that we've made mistakes as we deem them. And in reality, what we've done is we've executed our discipline. The discipline didn't work this time, next. You have to change how you talk to yourself. You have to change how you trade with yourself. You're the only person that actually is sitting there making these trades. It's you and the market that are interacting, and you have to find ways to interact and talk to yourself that you don't defeat yourself. And I know for a fact, because I do it, we all do it, that we lapse back into those periods of calling ourselves stupid, saying, doing things that we don't like. So you have to manage each of the components of what you see and what you do. Now, so that's how we manage the trade side of this. The longer term side of this, I'm going to use two examples that I want to try to get through. One is Facebook. And I'm going to go to a weekly chart of Facebook because it depicts what we're doing with the trade. We did a seminar I want to say it was June 26th of last year. We're coming up on a year right now on this, and we've been tracking it. For those of you who read the trading notes posted daily, some of you who've gotten on recently probably wonder why in the heck Facebook is on there every day. We did a seminar in June of last year, and part of that seminar was to build a long-term trade using a stock and letting that trade play out over the time horizon we set at the time was 24 to 36 months. We're roughly 12 months into this process, and I'm going to pull this over because this is a screenshot of the actual page on the site. This is the actual webinar that we did. The first trade was on 6/28 of last year following that webinar. So we did the webinar. We said, here's how you manage a long-term trade. And then we've been monitoring that long-term trade all the way through with Facebook. And I'm going to tell you the end result, and then we're going to come back and look at how we got to that results. And you can also, I don't have them on here because I didn't do a screenshot of all of this, but the notes start on 6/20, which was the original purchase, and the notes come all the way current following this trade. So we have validated everything that we've done historically with this trade to give kind of a learning tool. As one, it was learning by doing, and now it's learning by going backwards and seeing what was done. But what happened here is we invested $49,000 approximately. The gains on that $49,000 right now are right at $90,000 of profit. So we've returned 2 to 1, roughly, what we invested into Facebook over the last 12 months. And it's managing a long-term position on something that we felt was undervalued fundamentally. It had very little to nothing to do with technical analysis. The trades were motivated, entries and exits were done by technical analysis, but we use the fundamentals of Facebook, which, by the way, I still like Facebook. I still think that Facebook is well positioned. I still think that once it gets past some of this consolidation, you have some upside. We're now long 1,000 shares of Facebook, one at 63.30, another at 64.22. Over the last couple of months, we've added those two positions. And Facebook is kind of staggering along. But I want to go back and look at how do you manage these positions. It's not about the return. It's about what you do in the process of getting returns that matters. And this is a weekly chart. Please remember this is weekly. It's not a daily chart that you're looking at. And the entry was to find a low that Facebook had off of its IPO, which was back here at around $45 a share, that once it sold off and it based and it would start to break out, we gave this about 3.5 months to build a base, and then it broke out, and that's where we took our first trades. And you can see that we managed these trades off of trend lines. We managed all of the position wanting to hold longer term. As we felt that Facebook up here started to get extended price to value, in other words, is there value still left in the stock relative to the current price, based on where that Facebook was 3 or 4 months ago, we had to say no. They've made a couple of very good strategic acquisitions. They've overpaid by a lot of people's estimates. I wouldn't underestimate Facebook here in competing on levels that a lot of people have not anticipated going forward. But fundamentally, this is a very well-run company. It has very good leadership, right or wrong, whether you believe in Zuckerberg or not. Regardless, my objective is to make money. I'm not a Facebook fan. I don't even have a Facebook account. Our company has a Facebook account. My brother runs it. I have nothing to do with it. I am not a social media person. I'm an investor. I don't really care what they make. I care whether they make money making it. And so when I look at this, there were a lot of things within this that created worry in here. Matter of fact, we hit our stops right here. We got into the long position. This got a little squirrely with some news that was out early in this period. And so we started to look at how all of this started to unfold relative to this. But the actual long-term positions in this were created right in here. We traded it back here. We started to get into our long-term positions in here. We happened to time it very advantageously. And the reason we did this webinar in June was we felt that Facebook was basing and that it was holding support and that it was going to break to the upside, and we thought it was a long-term buy. It happened to be that. That's an earnings beat, and it's continued to be that along the way. We've traded it along the way. We haven't owned it long. We actually got stopped out of our longest positions back in March of this year, and then we've done some trades. We've done some put and call options against Facebook. We've hedged the position along the way. So to break this down, I'm going to write this down because it will make it clearer for me to slow down a little bit, is that when we got into the long-term position off of this here, we were looking at, I'm just going to use a 36-month time horizon. When you're looking long-term, one of the things that we look at is getting in, we want to get long, and then if the market starts to become volatile, we want to hedge against the longs. Now, if we have a profit, in other words, if you look right here at the price, here was around 34. Our average entry was just shy of 25. So we're up $9. 9 on 25 means that we had a significant capital gain. If we sold it, it would become a short-term capital gain. And we like to extend long-term trades as far as we can into long-term capital gains if possible. That didn't happen on Facebook because we took exits off of this and we were willing to just pay the tax and move on. Now, because we have to worry about these consolidation periods, so we'll hedge. And how we hedge is we use put options. And we don't straddle. If you have to create a name for it, I don't do it. If we buy puts. In other words, if in here we felt that prices were getting extended and they were at $50, then we're going to buy a put and we're going to buy time value out for as long as we think is prudent, and that's generally going to be 3 to 6 months out. So when we hedge a position, we're not hedging it for the week. We're hedging it going forward. We don't know whether that's just a blip or whether that's a correction. So we're going to hedge our position to monitor the profit, and that's really how you manage a long-term position, is you add to and decrease your long position as you go along by major market moves. And by this, I mean, you can see this was at 55 and it pulled back to 45. That's 10. That's almost 10%. To us, that's a significant move. We'll take money off the table. We actually sold 1,000 shares in there of the 2,000 original shares that we purchased, and then we eventually bought them back when they broke back above this. And you say, well, why didn't you just hedge it? We did hedge it. We sold 1,000. We hedged 3,000. And we were long 2,000. Hedging doesn't mean you don't want to make money. Hedging means that you want to protect the gains on the 2,000. But I don't want to sit idly by for months at a time and not make money from positions in a portfolio. That becomes dead money. So if it gets to the point where we want to take some off the table, we'll sell it. We always will hedge more than we own, because if it does go down, we want to make money on the put. So 2,000 of these shares were covered by the put. We sold 1,000 to gain benefit to the put on the position. So let me say that again. We're long 2,000. We buy puts on 3,000. So we buy 30 contracts on a $50 put, which at this point we were looking at, when we put the puts on, we're back in October, so we were looking at March of 14th puts at 50. As the price starts to erode and we think that it has momentum, which you can see it had 3 consecutive weeks of downside momentum, we'll take some off and make money on 20 contracts while 10 hedge the 1,000 that are left in the position. And then we make profit on the 20 contracts. And then when we take the contracts off and this reverses, we'll go long the other 1,000 shares to bring us back to the 2,000 share long position. And I know you can go back and listen to this video. Please do. But managing long-term positions is not just looking at trend lines. It's managing the personality of the market today. It's managing the risk of the market today against the positions that I own today. Projecting forward what I believe the personality of the market to be. Managing money, nobody ever said was easy. Managing money is an art, and it's a science combined. And it takes a lot of fortitude to stick to it day in, day out, and weather the markets, because they're emotional. And so we are still long Facebook. And we own 1,000 shares of Facebook currently. We don't have any put positions against Facebook. If we could clear this 60, whatever that is, 64-ish, 65-ish level on some volume, I would be very interested in buying calls against Facebook. I would buy the 65 calls 2 to 3 months out with a $72 target. If I could buy the $65 calls at the money, I'm going to get a 50 delta roughly. If I can move 7, I'm going to pick up $3.50 on the contracts. I'm going to pay on a $64 stock. I'm going to pay somewhere around $8 to $10 for the contracts. If I can pick up 3.5, I'm going to make 40 to 50% on the call contracts against a long-term position. That's how we trade options. We trade them very sparingly, but we trade them against positions that we know and are long in emphatically. So that's one that we've been in. Now I want to go to one that I haven't published yet. It's probably going to come out shortly, which is Twitter. And we think Twitter's doing the same thing that Facebook did. It's reinventing itself by the fact that now that it's publicly trading, they have to make money. Twitter has bottomed around the $30 level. Right now it's a trading mechanism. We bought a position in Twitter at $38.15, which you can see right there. That Twitter position was just taken yesterday. So we actually will build a position in Twitter if we can break this downtrend and we can get above 46, but from 38 to 46 is still a nice profit on a trading mechanism. But as the fundamentals of Twitter improve, I would love to own Twitter long term and trade it just like Facebook. I think it's been a great opportunity to watch Twitter and all the bantering about a $75 stock being a $30 stock, which it is. And now it's got to build itself. It's got to build its fundamentals. But Twitter is one that I would definitely be watching. And then I'll give you one that we've owned for a very long time. We've been long Google for eons. I mean, I think our average cost basis in Google going back is about $175 a share off the '09 correction. And we've traded it through all this. We've traded it through different components. But I am not a Google fan any more than I'm a Facebook fan from what they do. I'm a Google fan for what they are doing to the internet space and how they create opportunities. We bought 550 calls, which you can see right here today. I had a note on the chart to buy 550 or 560 calls based on what Google did today. We went long the 550 calls on the intraday pullback. If you look at Google on an intraday basis, you can see that it came back. It held support at 549 all day today. Those first two I thought were interesting. This one I found very interesting when it reversed off of the low. We went long 550 at 549.80 on the 550 calls. Those calls closed in the money today with the close at 554 on Google. But it's just managing a long-term position back into a short-term trade by knowing the company. And coming back to the daily chart, the other thing that I like about this setup right now is you've got this nice little A, B, C, D pattern that is moving. It followed through off of yesterday's move higher. It could come up to 560, hits 560 and resist. We'll take our call position off and we'll take a $4 or $5 trade any day on Google. We only bought 10 contracts, so we're not buying a lot. It's not a lot of capital exposure. The contracts were $24.90, so on 10 contracts you got $24,900 invested on the trade. You can see that this is also setting up from a longer-term perspective, which is one of the reasons I bought it and not that pattern that you see right there. But you do have a cup and handle that if we can take out that 565 resistance can run to 605, and that's what I want the call contracts to do, is run to 605. If they poop out on me, I'm willing to take the shorter profit. But if they run, then I'm in for the run. And if, by the way, if those call contracts run to 605 from a 550 entry, that's $55. We're going to capture a little more than half of that on the run. So it's going to be a $30 profit on 10 contracts is $30,000. So it's 100% return on investment. But that's managing long-term positions. That's taking all of what you know and bringing it back into positions that you're already in, that you're monitoring over a longer-term basis. And I think it gives you opportunities every day to manage your money off of what you know instead of always scanning and looking for a needle in the haystack. I love to scan. I love to trade like everybody. But I'm going to tell you, the most money that I make day to day is on long-term positions. I make it by trading off of them. I make it by owning them. Those are where I make the most money personally and for clients. And a lot of them never really show up on the website because most of the websites are, I call them your trade junkies. And you want to trade. So we give you the trades off of our long-term positions. But the long-term positions do make a lot of sense, and a lot of opportunity are built within them. So, use them. And I could go on. I'm out of time, but I could go on ad infinitum how many opportunities the market sets up for you every day if you're looking where they are. And, we started this on the egg, and I have a couple questions here running around that I don't know that I answered them or I didn't answer them, but, do you review the theme and development in the egg service like you just did in the oil theme? It's in the video, and I guess what I really need, we're making some revamps to the website relative to the egg. Right now, you've got, on the egg, you got one big adjustment change to the egg is, it used to just be the table. Now I'm giving you the scan results daily, and then the next evolution of that would be to create some type of a weekly video over the weekend that would set the themes up that give you a better insight into what we see, we being me, and I just have to find the time to do that, to be very candid about it. I do too many things, really. And I'm paring them back, and I'm cutting things out that aren't profitable. And I'm cutting things out that are not time profitable to me, not financially, but time-wise. I want my time back. And I'm working on that. What we're going to come out with, I would say in the next 6 to 8 weeks, is you're going to see a full training video series on how to use the egg, how to actually, if somebody cut my legs off today and said, Jim, you're only allowed one thing, then all I would ever trade is the egg. I would hold long-term positions and trade the egg off of long-term positions, because eventually Google, which you can see down here is an internet content stock. This is why I trade ETF so much, is FDN, that's the internet ETF. Look at what's going on right here. You have a very similar consolidation to what you had in Google, but FDN is breaking out. It retraced a little bit today, but it's breaking out. And if it breaks out, my bet is it takes Google with it. Now, the other side of that is SKYY, which is the cloud computing stocks, and Google really isn't, in my estimation, a cloud computing stock, but it's a cousin, and it has a very similar pattern of a cup and a handle on SKYY, which broke out 2 days ago, which would have been Tuesday, pull back today. But I would watch these things. These are all very similar issues that lead back to stocks that you own. And that, to me, is very important. So the long answer to your short question is yes, I would like to have a video that maybe is done over the weekend for coming into the trade week for Monday for how the setups are there. That limits me to only having to do one video. I could probably do it in a 15-minute overview because it's focused and it gives you that. But the training videos, I'm going to tell you, are going to be worth all the money that I charge for them, which may be about $50,000. Because once you learn how to control the egg format of trading, and I've gone back to, I kind of abandoned the egg for a while and I've come back to it. I think the egg is the greatest tool for learning how to trade money because it really teaches you to focus and it teaches you to manage the emotional components. If you own the egg today and you have $160,000 invested in TAN, I guarantee you you're watching that. Now, unless you have $50 million of other money, that TAN doesn't interest you that much. But when you expose $160,000 to one asset, you're going to watch that asset. And that's the magic. You're going to learn whether or not you're cut out for trading. You're going to learn whether or not you can do this. And yes, you got to ratchet up your money. And yes, you got to ratchet up. I know some of you may start with 25 and go to 50 and go to 75 to 100 to 150. But, you know, my goal is to get to where every day I'm trading $1 million of my money in the egg whenever it is posted. In other words, if it were TAN and I bought $1 million worth of TAN, then, you know, I would have whatever that comes out to, 160 into a million. So I would have roughly 22,000 shares, and it's up $2 a share. That's a $50,000 gain. And that's 5% on my $1 million portfolio. That changes your lifestyle. it becomes an event. It doesn't just become a trade that I made a nice profit on. It becomes a life-changing event. $50,000 could buy you a Lexus, after tax even, probably buy you one. And the federal government will actually start sending you thank you letters because of how much tax you pay on an annual basis. But the reason you make money is to spend money. If you're making money to hoard it away like a squirrel, then you're going to run around like a squirrel nuts. You run up trees over wires and jump over things. And if you ever watch a squirrel, they run crazy. And I call it squirrel trading. If you're squirreling money away, you're a squirrel. You're running around crazy. Spend it. Give it away. Be philanthropic. Do something with your money other than watch it. It's not. If you had one picture mentally or on your computer, it should be of a U-Haul is never going to be seen behind a hearse. You can't take it with you. Make it, spend it, make it, spend it. Stimulate the economy. For God's sakes, GDP is stuck at 1.5%. We need some of you to start spending some money so that the GDP will go up and stocks will have justifiable prices. But it's a lot of fun to trade the egg, but and I've ignored some of the other models that I dearly love. The S&P 500 model, by the way, is beating the S&P 500 index this year because of the way it's designed. The way it's designed is to outperform the S&P, be overweight to the sectors that are moving, underweight to the sectors that are not. It's 100% invested right now, and you can see it's overweighted to energy, it's overweighted to utilities, but it's a great model that tracks along. But it's boring to some of you, but it's a great model. The 401k model, by the way, has finally got its historical trade records posted. We finally finished that this week. Digging back through the archives of our files to find the 25 years of trading records was no fun. But that model's been run for 25 years, and it's been very good for 401k management, and it's great for IRAs. It's great for other things that are similar to that as well. So with that, I'm going to shut up. I'm going to go have a beer, and we'll get up tomorrow and do this again. But I am working on some things as far as the egg is concerned, and hopefully in the next 4 to 6 weeks, you're going to see all of that stuff come out. The 401k part is done now, so I'm going to have hopefully some videos for that as well. Next week, what are we going to talk about? Next week is the final week to this Telechart, how to use Telechart desktops to better manage your money. I'm gonna kind of summarize some of what we've talked about, but I want to go back to maybe we'll dig a little bit of the how we run some of the models and how we use Telechart to do that. And what I would look at, and I know my brother has some other stuff for me that he wants me to do, but I'll look at the S&P 500, and then we'll look at the sector rotation model next week, and we'll use those two as our teaching tools for how to set up scans and things within those. And for those of you who don't track some of these, the S&P model, the model is built, it only has 10 investments, which is the S&P 500 sectors, makes 1% a month. The goal is to not lose money. So it's kind of a methodical plotting strategy that we've used for over 20 years. And the sector rotation model is just that. It looks for the rotation of the market, and we'll look at how we look at that and some of the theme development that we use within the rotation model. But it drills all the way down to stocks, which is why I want to bring it in. It'll show you how to get to the stock level. Because when I teach a lot, I stay on the ETF level and the sector levels, but we'll get down to the stock level relative to all that. So with that, have a great weekend. You'll get an email on the topic as we go through into next week, and we'll see you next Thursday.